Alright, so the past few weeks, and you could say month and a half, the price of oil continues to get hammered, right? And this is quite interesting because if you look at it, the $65 handle where the price of oil is at right now, a lot of these shale companies are going to face problems. From what I've read, they're hedged around $90 a barrel. So in the short term, it's not going to be too much pain. But in the long run, if these prices are sustained at this level, trading below $80 a barrel, then you're going to see this sector get hammered hard, right? So you're thinking that, hey, lower oil prices, this is great for consumer confidence, etc., etc. But here is one of the conundrums out there. Not conundrums, but here is one of the items that no one's really talking about. Actually, CNBC did talk about it, and it's talking about the junk bond market in terms of the oil market. Alright, so let's read this article, part of it. Could oil collapse cause next credit crisis? And it starts out by saying it's not just the Saudis who could get much more poor from the oil price freefall. Everyone could suffer if the collapse triggers a wave of defaults through the high yield debt market and in turn hit stocks. First of all, the banks that were last hit by the housing crisis. Why could that happen? Well, energy companies make up anywhere from 15 to 20% of all US junk debt, according to various sources. In fact, they have been the most prolific issuers of high yield debt over the years, as their share of the market was just 5% in 2005. The oil bull market we once knew filled their coffers and made executives feel confident they could borrow more and more money. Much of that high yield debt is now on the books of the banks, asset managers, and pension funds. What's more, banks are even more dependent on a happy junk market as they make a market in the bonds. Any collapse in prices could cause bidders to run and liquidity to dry up. And as a side note here, so far I think this is what's going on right now, and also people are just scared when it comes to the oil prices. So people are saying, hey, there's forced liquidations going on right now, so this could be a temporary correction with the price going up. But then we shall see. If this problem continues on, I wouldn't be surprised if we see $60 oil within the next few weeks or months, right? I mean, that would have been impossible to many of the individuals who are following financial markets. I know that I've seen some traders on my blog say that, hey, I see lower oil prices coming. I do know one analyst by the name of Keith McCullough at Hedgeye. He was saying $65 a barrel oil, right? He says deflation's going on. But anyways, let's go back to the article here. I have no doubt that the high yield sector will get bad, but the worry is that because of the general lack of liquidity in high yield overall, that it could be an environment that makes contagion very much a possibility, says James Farrow of Coughlin Capital. There are cracks, but certainly no contagion yet. And then we could go forward. This is one thing I've seen over and over again, said Larry McDonald, head of U.S. strategy at New Edge USA Macro Group. When high yield underperforms equity, a major credit event occurs. It's the canary in the coal mine. Since the turn of the last century, there have been 12 times when the value of high yield debt dropped at least 10% in 60 days, according to Kinshow, a quantitative analytics tool used by hedge funds. 60 days after those credit events, shares of Citigroup had a median return of 8%, B of A stock had a median return of negative 6%, JP Morgan took a hit of 5%. This may not seem that bad, but those are just median returns, including times when high yield falls just 10%. The decline in these stocks and prices of high yield bonds could get much worse. And then the last line of this article is, if the high yield market in its fragile state is given a push, we could see a real rout in the markets, wrote Farrell from his blog on signalia.com. So this is quite an interesting article because it actually talks about what I've been following for the past few weeks, that if oil prices go down, there could be problems brewing in the US junk debt market. And people told me that, hey, there's no bubble in the bond market. If there's any bubble, it's in the junk bond market, right? And that's ready to pop. This is what one trader told me probably 6 months ago. And if this trader was right, one of the bubbles may be this energy market, right? Long term, I'm still bullish on oil and other commodities. Short term, yes, we do have a hiccup. But this is quite interesting over here. Because last time around, no one really thought that subprime was contagious. And then we know what happened right after subprime, right? The year after, even though keeping interest rates at 0% or keeping artificially low interest rates in the marketplace, that did not solve the problem. It actually led to 2008. So, this being said, if central bankers decide not to get behind this and not inject liquidity, yes, we're going to definitely have problems. And we've seen the past 5 years, right? They've gotten behind every problem, behind closed doors and in the open as well. So, if you see oil prices continuing to go lower, it's in my opinion that Janet Yellen, as a dove as she is, she will not be raising the Fed funds rate. She will be most likely working behind the scenes to prop up this junk bond market, or she's going to openly announce that she's going to be propping up this junk bond market should we see more problems. Because the thing is that, sure, these banks that are having problems right now, from what I've read, maybe Wells Fargo and Bank of America. I know Wells Fargo is involved in loaning some of these companies money. So they're going to take a big hit. But the next issue is, what do the derivatives have in terms of investments in this shale revolution, right? I mean, normally you wouldn't think that much, but once again, this is an unregulated market, the derivatives markets. In addition to that, there's a quadrillion dollars worth of derivatives floating around, right? So we don't know what's in there. So if we knew what's going on in the derivatives markets, then we could determine, okay, is this going to be contagious? Is this not going to be contagious? But we shall see. But if we see oil prices continue to stay lower, that means I will see, or I will expect to see, problems in this junk bond market unless they're already intervening. The central bankers are already intervening in this market. But this is potentially a black swan that the central planners did not see coming, right? Subprime was a black swan. There were problems in the credit markets. We could potentially see problems in the credit markets occur right now. Even though the first headline would be, hey, oil prices are going down. Yes, they're going down, but what's going to happen in the junk bond market, right? Anyways, guys, thanks for listening, and I'll talk to you later. Bye.